The real key to fiduciary duty is just remembering that if there's ever a conflict between your personal interest and your investor's interest, you have to choose your investor's interest. But you may be in a situation where you're just faced with two choices and there's no conflict. Is it better to get the cash flow or is it better to sell the deal?
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 185. My guest today spent 12 years as a corporate attorney for some of the most prestigious law firms in New York, Boston, and London. And then he switched tracks and became a full-time multifamily real estate investor and syndicator. Jonathan Twombly is the owner of Two Bridges Asset Management, and his attention to detail, creative thinking, and tendency to notice overlooked connections has had a huge impact on his returns. Jonathan also hosts the Real Estate Launchpad podcast, and I was a guest on episode number 28. So it's great to be able to continue our conversation. Jonathan, welcome to the show.
Thanks for having me.
Why don't we start with you just telling us a little bit about yourself, who you are, and how you got started investing in real estate?
Sure. Well, as you mentioned before in the introduction, I was a corporate lawyer in New York City doing commercial litigation. So basically, I was representing mostly, large companies fighting with other large companies over very large piles of money. Wasn't terribly satisfying. It did pay really well. So I had kind of the golden handcuff situation there, stuck in a super high paying job that I really didn't like very much. Towards the end of my career as a lawyer, I was focused on a lot of real estate related litigation. So I was representing a lot of hotel owners in particular who were fighting with the management companies that brand and manage the hotels. So I started getting a lot of kind of a look into the back end of real estate deals, when they unraveled, right? And one of the things I noticed there was some of the individuals who worked for some of these companies that own these hotels would have little pieces of the deal themselves. And I remember thinking, wow, that's really kind of cool. Like, here's this guy who works for this construction company that built this hotel, and he's got this little 1%, piece of the deal. And, I would have no idea why that guy had the 1%, but knowing what the hotel was worth, like, that little 1% of the deal is worth $2 million right now. And I thought, gosh, I would love to be in that situation myself. I started looking at a lot of real estate deals, and I was really unhappy with what I was doing. So a couple of things happened. One was the great financial crisis happened, and we were kind of bracing ourselves for this massive wave of litigation because in past recessions, that's what happened. People will be looking for somebody to blame, and it all starts suing each other in recessions to look to collect from somebody. But the financial crisis was so bad that nobody wanted to spend money on lawyers to go after other people. So I was actually sitting on my hands, just doing nothing and collecting this big salary. And to kill time during the day at work, while I was sort of waiting around for somebody to bring me something to do, I would get online and look at real estate deals and sort of fantasize about owning enough real estate that I could quit my job and, not work the insane hours anymore and deal with the insane people I was dealing with as a lawyer. So I was, spending a lot of time sort of learning how to do deals. And after a while, it took a couple of years, but my firm finally said, makes no sense for us to be paying this guy all this money to be essentially surfing the internet all day. So they decided to let me go. And I'd kind of had an inkling that this was coming, started doing some networking about getting into real estate. Having come from a big corporate background, I was just sort of assuming that I was going to go do some kind of corporate real estate job. But as I was networking, I kept on running into the same response from people, which was, Jonathan, I'm going to be honest with you, at your age, with your background, it's going to be very difficult for you to break into this field. People are looking for younger people. I was about 40 at the time. Plus, there are 10,000 guys on the street who just lost their jobs, who already have 10 years in real estate, and those are going to be the ones who get hired first. So the only way you're really going to break into this field is if you just get lucky and someone says, hey, I like you a lot, let's partner up. And as I was out there doing networking, that exact thing happened. I was just talking to everybody I could find, and I met a woman at a networking event who wasn't a real estate event, right? It was just a regular kind of networking event. And she said she was in commercial real estate, so I asked her out for coffee, and we started talking, and she said, I'm starting up this real estate investment business. Would you like to join me? And shortly thereafter, I finally got, my notice from my firm that they were letting me go. So I knew I was going to have to be looking for something else. And I wasn't really sure whether I wanted to hook up. I wasn't, I really was still uncertain as to exactly what I wanted to do. But I thought, well, at least I should explore this opportunity. So why don't I talk to a couple of friends that I trust? So I reached out to a couple of friends whose opinion I valued, and said, what do you think about this? And they said, well, let me meet her. So I kind of did a little road show with her, taking her around to some of my friends. She impressed them enough that my friends wound up saying, if you decide that you want to partner up with her, we will give you money to invest. So suddenly I had this offer of like a partnership in a startup on one hand, and like $2 million of soft commitments of investor capital on the other hand. And I thought, you know what? This is something that I need to try. Like, the universe is telling me something. I should try this.
This is interesting. So you lost a job where you had a steady paycheck. I mean, a very good corporate job as an attorney. And I would imagine going into a partnership with this woman, even though you had a soft commitment for $2 million in investment fund, you probably weren't getting paid anything to do this. So what were some of the thought processes going through your head at the time?
So one thing was that I knew I didn't want to get another law job, right? I mean, I knew I was done. I'd been trying to get out for a while, although I could never figure out what exactly to do with myself, which is why I hadn't been able to get out sooner. But I knew I didn't have the stomach to go look for another law job. So I knew I was going to have to do something else. I was fortunate in that I had money saved up because, my habit has always been to live very frugally. I saved a lot of money. I remember when I was working as a lawyer, I was the sole breadwinner of my family. My wife didn't work. We were living just fine, had a very nice life, and were saving a lot of money. And I would talk to my colleagues who were constantly complaining about not having any money, right? And I'd look at them and I'd go, well, I know how much money you make because you make the same as me. And I also know that you're married to another lawyer or a doctor. So you're probably, between the two of you, making double what I make. How come you have no money? Because I'm saving a ton of money. And, you dig into it and you find out, well, they have the summer house and they have the kids in private school and they had 2 Audis that they drove and they ate out every day. And it was sort of like, they spent their money as fast as they could get it in the door. But because I was so frugal, I had enough money saved up that I was like, you know what, I have the ability to take a chance and do this. And, if it doesn't work, it doesn't work. But at least I have the ability to give it a shot. So you're right. I wasn't getting any money in the door, which was scary. But on the other hand, I had some cushion to fall back on while I was doing this and able to devote myself to it full time.
Yeah, it's a huge leap of faith to go from a corporate job with a steady paycheck, even though that job was no longer there for you. But to go from that to the uncertainty of starting your own business.
Well, I mean, there's something really, I have to say, very freeing about getting laid off, because I wouldn't have left the job to go pursue this opportunity, right? I mean, that would have been a leap too far, giving up the steady, certain paycheck to go into this, full time into this uncertain venture. But once the decision was made for me, then it was a totally different calculation, and I realized I was in a position to take a chance and take a risk. So I did.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. And this woman who you went into partnership with, I'm sure, being the cautious guy that you are, you wanted to do your due diligence on her. And part of that was getting the validation from some of your friends whose opinions you respected as to whether or not they would even want to invest with her. Can you talk about just how you vetted this partner?
How I vetted the partner? Well, yeah, it was, we met a number of times ourselves to try to get a good, feeling for each other, kind of talk through what her background was. She'd had experience in the field. She and her husband owned about 700 units of property at that point. And so I felt like she had a good grasp of what she was doing, but I just wanted a reality check on her. So that's why I kind of did the tour with some of my friends to see what they thought. And, these were financially sophisticated people. So I figured that they would be able to ask the right questions and maybe see stuff that I wasn't seeing. And she obviously impressed them, so we were good to go.
Great. So tell us what happened then. So you went out looking for some properties together.
Yeah. So it's really funny because my thoughts about what this was going to mean and the reality of it were very different. Being from New York and living in Brooklyn, I was the real estate conversation that I was surrounded by was people buying brownstones in gentrifying areas, and really even the story of not even people like buying them as investments, but it's all those people who got lucky, like the school teachers who bought the brownstone in 1985 for $100,000 that was worth, $1.5 million at the time. Now they're worth $4 million, and thinking like, gosh, like how do we get in on that kind of thing? And then when we sat down and started really talking, like after we decided to form this partnership, she was like, oh, no, we're not doing that. We're going to go be buying, 100-unit apartment complexes in Texas and Louisiana. And then I was like, oh my God, like how are we going to do that? Like we could buy 100 units of apartment, like that's nuts. And then I found out that, the price of the brownstone and the price in Brooklyn and the price of the 100 units in Louisiana was like the same, right? So,
so the income potential is a lot more with the 100 units.
Oh yeah, exactly. And with the 3 units in Brooklyn, I mean, it was a pure appreciation play. You weren't going to make any cash flow on it. Whereas, 3-4 deals in Louisiana, and I couldn't replace that income that I was giving up, but I would be at a point where I could live off that money, right, and build from there. So we started looking around in Louisiana and Texas, and this was right after the financial crisis ended. So it was kind of a weird time to be looking for deals. There was opportunity out there, but the sellers were still looking for 2008 peak prices. Some of them, frankly, had more debt on the property than the property was now worth, and they were trying to at least get enough for to be able to repay their loans, which when you underwrote the deal didn't make sense. So it was kind of a tough time to find deals, just not because there weren't deals out there. It's not like now. I mean, it's not as tough as it is now, but it was still tough because there was just this mismatch between sellers and buyers. But we kept plugging away. Over the course of about a year, the sellers started to get more realistic. They realized that, this correction in the real estate was going to last for a while, and some of them wanted to move on, free up capital to invest in stuff themselves. So we started getting a little bit better, and we finally wound up getting a couple of deals under contract. I think there was like the first one was they were like 110, 120 unit deals. down in Louisiana that we got under contract, and we're kind of pushing forward to close on. And
what kind of pricing were you getting?
Oh gosh, I mean, this is a long time ago. So I think one of them was a $3.1 million deal, and the other was maybe closer to $4 million. But we were buying these things at like $30,000 a door, more or less, right? And they weren't the greatest properties. I mean, they were kind of rough around the edges. I'd call them probably like C minus properties, but they had a little bit of value add to them. They cash flowed really well, and we thought, well, this is great. We'll do these two deals, be 2/3 of the way to the three deals that we really need to be kind of like living off the money, and we're pushing forward. What happened though was, I think it was a combination of things. I mean, the lenders were all over these deals because they cash flowed really nicely, but I think over time they started getting a little bit more skittish because the environment was still so, after the crash, people were just very anxious, and it was also Louisiana, which, no offense to the fine people in Louisiana, but I think a lot of banks were a little bit wary of that market, right, in terms of it being so tied to energy prices and, various other things that people sort of felt about the market. Sure. So we were really on the verge of closing both of these deals, and at the last moment, the lender pulled out of one for reasons that, when I talked to banker friends later on, they were just making excuses. I mean, none of the things they said made any sense, but they came up with a list of really kind of cockamamie reasons not to do the deal. And then the second deal, I think with that recently in our minds, the second one, we got skittish. We found something. There was something, the apartment was kind of a weird 1970s construction where they had like one hot water heater for every 4 units, right? They had like a common hot water heater. And it's something that wouldn't bother me now, but we sort of freaked out about this. We thought this was like horrible. So we wound up pulling the plug on the deal ourselves. And between the two deals, we were out a lot of cost. We had lender fees, we had all of the due diligence expenses that we'd put up, we had legal fees. So, we pulled the plug on both these deals and wound up like really kind of, not just was I not making money, but here I was now out of pocket a lot for these two deals that didn't work.
That's never fun. I've been in that situation too. And you really have to get past that emotionally and psychologically to move on.
Yeah. I mean, it's one thing when you've got other deals that are paying you, that are working, to have a deal like that. But when you're still trying to get your first deal done and you can't close because the lender pulls out on you, it's pretty tough to stomach.
If you are thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition 5 years ago, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional healthcare insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage, or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. Not to mention, I'd imagine you had investors lined up for those deals.
We did, but the investors hadn't put up any money yet, so they weren't harmed anyway. We had fronted all of the money ourselves for deposits, which we got back. We got the deposits back, but we still had those unrecoverable deal costs, right, so that we had to eat. But the investors were not impacted at all, which later came back to help me, because what happened next in the story was that that partner and I decided, after that second deal tanked, that we probably should go our separate ways. I mean, over the course of working together, we had come up with, I guess we just started to just understand that we had kind of different takes on things, right? And we weren't seeing eye to eye on a lot of things. And it never was, it's never acrimonious, but I think we were adult about it and realized that, hey, we've seen enough of each other and probably realized that this might not be the best working relationship going forward. So why don't we just make a clean break of it at this easy point for a clean break? And so we did. So we split the partnership up.
Well, yeah, and let me just add something there. So that's important to know. I mean, because in this business, you can have a partner, you can have partners, but you're not married to them. So usually, if you treat your partnerships on like a deal-by-deal basis, to me, that's a better way to go than to say, okay, everything we do, we're going to partner together from now until the end of our careers.
Yeah, I mean, I think you could do one or the other, but I definitely recommend that you, at least at first, work with people on an individual deal basis, And I mean, I'm sort of, just to jump ahead in the story, I'm at the point now where I'm looking now to bring in some additional partners. And there are people that I've worked with on deals over the years that I've gotten to know well. I know what their skills are and their strengths are. And those are people that I feel quite comfortable with in saying, let's form a partnership and go forward and do a bunch of deals together. But I doing it without that background of, in both of these guys' cases, I've known each of them for more than 5 years, right? And so I think I know them well enough to feel like, okay, I know what makes these guys tick, and I know what their skill sets are. And that's a different situation than the one that I got into before, which is where I met somebody that barely knew and said, okay, we're going to do business together, and just jumped into it. So all's well that ends well. We ended on a amicable basis, but at the same time realized that, hey, we probably have different work styles and let's just move on. So at that point, I was like back at square one, really didn't know what I was going to do.
Yeah, you were back at square one with nothing to show for it, really.
With nothing, well, actually with losses, right? So
with less money in your bank account.
Less money in my bank account. Yeah, I mean, I had some nice tax losses, but it didn't, it took me a couple of years to use them because I didn't have much income. And, but I was talking with one of those friends who had initially offered to invest in deals. We went out to dinner and I said, gosh, I don't know what I'm going to do. I might have to go back to practicing law. And he said, no, don't do that. Why don't you and I partner up? I'll just stay in the background. You run the show, and I'll just set it up so you can do that. So that's how Two Bridges was formed. And that was back in 2013. It wasn't quite starting from zero, because I had made all these relationships and I'd learned a lot about the business. I mean, I was no longer, a complete novice. I hadn't closed a deal, but I had gotten right up to the edge of closing 2 deals. So I'd been through underwriting and due diligence and the whole lending process and the syndication process. I mean, really done everything but closed the deal. So, I felt like I was ready to take that on at that point. But again, it was sort of, I was an unknown person. I switched markets. I wanted to do something closer to New York, so I was looking in South Carolina instead of Texas. And I'd made some relationships there, but I basically had to start all over again. So it took me another year before I was able to find a deal that I liked and was able to get under contract. But that one, fortunately, we were able to close, finally. So kind of beginning of the process to getting the first deal done was like a 3-year ordeal.
Yeah, but you stuck with it. Why did you stick with it? Because that's a long time to go.
Yeah, part of it is I really didn't want to go back to practicing law. Right? I mean,
the alternative was unthinkable.
The alternative was unthinkable, and I felt really strongly that I wanted to make a go of it. I mean, I really wanted this to work, and it had been a dream. It was like looking like becoming reality, and so I just wanted to make sure that I'd push through to get it done.
So you picked up your first property in South Carolina. Tell us a little bit about that.
So that was a 102-unit deal in a place called Spartanburg, South Carolina, which is on the I-85 corridor between Charlotte and Atlanta. It's kind of like the manufacturing belt of South Carolina. And went down there. I got an introduction to a broker and flew down to meet her and the rest of her team, and just got very lucky. I walked in the door. It was a warm introduction, so we didn't. I didn't have to like legitimize myself. They were already treating me like a pro when I walked in. Obviously, they had done their background research on me and found the website and found all that sort of stuff. So they thought that I was able to close, and I walked into their office, and after we got through sort of our chit chat and what I was looking for, they said, "Well, look, we just got a deal yesterday. We haven't even marketed it to anyone yet. We haven't even put the materials together yet. But how would you like to go look at it?" And I said, "Well, yeah, absolutely." I went out and drove. My first impression was, gosh, this looks so much better than those deals that I was looking at in Louisiana. It was still an older property, but it was just a nicer area. The property was in better shape. It just didn't look to be quite as down out as those first deals. Put an offer together. The brokers convinced the seller to take it without going to market, and we got it done.
Did that finally justify those 3 years of hard work that you put into it? Hard work and disappointment?
I don't know if it totally justified it. Certainly not economically, but I collected an acquisition fee, which was great. That definitely gave me a taste, right? Said, okay, I'm on the right track here. And I was in business, so once we closed that deal, then brokers started paying attention to us and started getting a lot more deals coming our way. The phone started ringing with brokers once that deal became public, and then it just became a lot easier, at least on the deal side of things.
Mm-hmm. What about the money raising side? How much did you have to raise for that deal?
Well, so that deal only had one investor in it. It was one of my original investors. So I think we had about $1.3 million of capital all in that deal.
Nice. So you were able to bypass the whole syndication process and just work with one investor. That's awesome.
Yeah, I mean, it was still a syndication technically because it was had a passive investor. It wasn't a partnership. It was a GPLP structure, but it was only one LP. So we still syndicated it, quote unquote. But you're right, we didn't have to go out and pound the pavement and try to raise money from a bunch of people. So that made life a lot easier. So
being an attorney, like how much of your own legal work did you do, and how much did you need to outsource to other attorneys?
I did 0% of my own legal work.
Why is that?
Well, so this is probably going to sound funny to all the listeners out there who are always trying to figure out how much they can do themselves and not hire lawyers for. I guess the thing is, being a lawyer and being a professional in the business, I knew what I didn't know. And I was not a deal lawyer, and I was definitely not a real estate deal lawyer. And I didn't trust myself to try to do those documents on my own. Wasn't a syndication lawyer. I'd litigated securities cases. That's a very different thing than putting the documents together. I wouldn't have known the first place to go put together syndication deal documents. And as a lawyer, I knew how serious this is, right? I mean, this is not amateur hour. Maybe as an amateur, you can put together an LOI. I did draft the LOI. I did that. Like that I felt confident to do myself. But for anything else, I knew I needed a local property lawyer because I wasn't licensed in South Carolina anyway to practice law, so I couldn't close the deal myself. And I didn't feel confident in doing any of the other legal work. And frankly, I didn't want to. I mean, that was another thing. I really had no interest in doing it because that was what I was trying to get away from. Mm. So, I was really happy to go find other people to go and just pay them to do it instead and work it into the deal costs rather than to have to do it myself.
So did you then hire a local attorney in South Carolina to do the purchase agreement as well?
Absolutely, yeah. So I hired local counsel in South Carolina, hired someone here in New York to do the corporate documents.
So even though you didn't do any of the legal work, how did having that experience as an attorney help you through this process?
I found that being a lawyer has helped me in ways that I really didn't expect it to. And the way that it has helped me most is that, law is a client service business and syndication is a client service business. So I think that I just applied my sort of normal standard, sort of high quality standards to all of the marketing materials I put together, all just the way in which I approach clients, and people responded really well to that. I think because maybe because I was used to working on Wall Street where you were held to a very high standard, and I just brought that into my business, and just purely by accident, I think wound up being a higher standard of kind of customer service than a lot of people were used to in the syndication field. So, people would compliment me on like, wow, your deal documents look really great. Like they're really easy to read. They're easy to understand. They're very persuasive, so stuff like that. And also just having the basic, like very, very deeply ingrained, because I had been trained this way, to think of myself as a fiduciary, right? So like it's not my money, it's the client's money, right? Like I'm their fiduciary, I'm their agent. Like my job is to make them money and put their interests first. That, after 12 years of being a lawyer, that was like so deeply ingrained in me, I couldn't escape it if I tried. But I think a lot of people come into the business just thinking about how much money they're going to make, and clients are just sort of a means to an end. It's just a guy with a check who's going to write a check that's going to help make me money. That really wasn't my attitude at all. My attitude was like I felt almost like a sacred trust. Like my duty is to them. My duty is to make them money. If they don't make money, I don't make money. I couldn't possibly put myself first in that situation. So I think that part of the background really helped. And I wasn't expecting that. Like I didn't until I got into it, didn't realize how important that sort of customer service and fiduciary aspect of being a lawyer would help as a syndicator. In terms of like the legal skills, it's probably much easier for me to read and understand the contracts than for people who don't have a legal background. So that probably helped, but I wouldn't really consider that to be a major part of my business.
So I'm curious. So I totally get like you having the standards and the understanding and reverence for your fiduciary responsibility and client service. But I want to push back on one thing. And you say when you put together your marketing materials and investor materials, people commented on how easy they were to read and understand. One of the things that maybe this is just a stereotype or maybe this is my experience, but you having come from a corporate background and being an attorney, a lot of times you're speaking, in your corporate world, you're speaking at a different level than most people understand. And when you look at contracts and you look at things that attorneys have put together, a lot of times it takes a lot of deciphering. So did you have any trouble bringing your words down to a level where people can understand you?
No. So interestingly enough, you're right. When you're dealing with like you're writing legal documents or you're writing briefs that are for a court, you're writing for a legal audience, right? But we also had to do a lot of writing for clients, right? We had to do a lot of writing, writing memos and writing letters to clients explaining their legal position or whatever. And I from a very young age as a lawyer, I had it beaten into me that when you're writing to the clients, you can't fill you're writing with all this like mumbo jumbo that's difficult for them to understand. So, I was taken to task as a young lawyer by the people that I was working for of having like my client facing stuff be too legalistic and not easy enough to understand. And I also was fortunate that I did some marketing too when I was a lawyer for the practice group that I worked for. And it was the same thing. It was like, you can't be all legally in this marketing stuff. You need to break this down and break these concepts down so that they're more easily understood by the audience that we're trying to reach. So I actually did have that training as a lawyer for taking difficult legal concepts and breaking them down so that they're more easily understood by people who didn't have the same training.
That's funny, because I always suspected that it was just the opposite, that attorneys were trained to write and speak in such a way that the average person could not understand them, so that they would have to keep spending money to hire them to interpret what was going on.
I mean, listen, without getting too sidetracked on this topic, I think that it depends a lot on what level of lawyer you're dealing with, right? And I don't mean that that in a way of like saying, oh, I'm so great and these other guys are terrible. But I think, most people, when they're dealing with lawyers, right, they're not necessarily dealing with like the very, very top of the profession, right? So I think a lot of the reason why lawyers get such a bad rap is because the average lawyer that your average person is dealing with is not like the top of the profession, right? So I think there is some of that stuff going on. I think there is some of that, like proving that I'm the expert. So, and I'm going to show you that I'm the expert by making things really confusing so that you think I'm really smart and you also are dependent on me, to do this for you. But I think at the other end of the spectrum, where your clients are like these billion-dollar companies and they're paying law firms incredible amounts of money to do their legal work, like it's a very different. The relationship is inverted, right? I mean, you're like really kowtowing to the client, and the clients are all very sophisticated people, and they just a lot of times just won't put up with it, right? But you're also, I think, sophisticated enough too to realize like everything that you're putting together is and I think not just lawyers, like anybody who's listening to the show wants to do a syndication business should really understand that every single thing that you put out there, right? Whether it's an email to a client, whether it's a blog piece that you write, whether it's a Facebook post about real estate, every single thing that you write is a marketing opportunity, but it's also an opportunity for people to look at you and say, boy, this guy's a real idiot, right? If you don't do it right. So you should think about all those things as part of your marketing effort. And that I was trained to do that. I was trained to, I was taught how to write emails, right? When I was a lawyer, like write an email. Don't just send the guy the document, right? Don't just say, here, document attached. Like you have to write a synopsis of what the document is so that he doesn't have to open the document to read it to find out what it is, right? And that should be written in a certain way that's easy to understand. And there's kind of like a structure to it. And so that kind of stuff was beaten into me. Like every email is marketing. Every memo that you do is marketing. Like you have to be conscious of it. So obviously, like no typos and no grammatical mistakes and, nothing weird, so like it was all, I had that just beaten into me from a very young age as a lawyer.
I think that's really helpful to anyone trying to raise money. And you talk about the client relationship background of being an attorney. And by the way, I'm being somewhat unfair with my earlier question because I have worked with excellent attorneys who are very good at dumbing things down for me so I understand them. So you're absolutely right. There's great attorneys out there. But I'm wondering, from that client relationship perspective that you learned as an attorney, what are some of the other lessons that you could share with us when it comes to just whether it be writing emails or communicating with investors, sellers, buyers, what have you?
Any sort of situation where you're marketing yourself in any way. So, it doesn't have to be like marketing in the sense that we think of it as like I'm marketing my business, but like marketing in the sense of like you're presenting yourself to the world. It not only does it help to be clear and organized, but it also helps to be concise. So be short. Like don't go into too much detail, just enough detail that you need. But also to tell a story, right? You need to capture the attention of the person that you're addressing by telling a story. And you have to figure out a way to grab their attention, and then, whatever fact you're trying to convey, you want it to be interesting to them, right? And you want it to be a part of a story that captures their imagination in some way. And I'm not saying like you write, if you're writing like, please see document attached, that you have to like write that into a story about the document being attached and weave it into like some Game of Thrones thing. That's not what I'm talking about. But like you have to be, when you have an opportunity to be persuasive, or you need to be persuasive about something, the best way to be persuasive is to tell a story with what you're talking about.
Give us an example.
If you're putting together a package for a deal, right, you want to tell the story of the deal, right? You want to tell the story of, what is this property and what is its potential? What is it now and what can it be in the future? What is this market like and why is this market so great? And obviously you've got to run this by your attorneys because you don't want to promise anything that you can't promise or mislead anybody in any way. But at the same time, you want to, as much as you possibly can, you want to cast this in like a narrative that has a beginning and a middle and an end, and kind of like takes the reader through, so they can see in their mind like, oh, this property is like it's rough and it's a C property, but there are all these people moving to this area, and this company just moved into this area, and these great jobs are coming in, and we know that this property can serve a different renter base, so we're going to rehab it, and this is how we're going to rehab it, and try to make pictures in people's minds of what you're going to do. And pictures are important too. Images are very important when you're doing these materials too. So you want to make sure that you've got pictures of the property and pictures of the exteriors and the interiors. And for people who are not going to go and visit the property in person ever, you want them to be able to imagine in their mind's eye exactly what this property is, where it is, what it looks like. So the more kind of pictures and maps and street views and aerial shots and whatever it is that you can add to it to help them picture in their minds what this is going to be and how it's going to change and how they're going to benefit from this is going to help sell that deal.
Yeah, telling a good story is instrumental. I'm wondering how you incorporate creativity into your business.
Well, I mean, I kind of feel like real estate is a great opportunity to be creative. I mean, God, there's so many different ways. And this is one reason why I was so unhappy as a lawyer and really wanted to get into business for myself, because I felt like I wanted to be able to create something from nothing. I wanted to build something. So, even independently of the deals that you're doing, you're building a business, right? And you can say to yourself, what do I want this business to look like? What do I want the culture to look like? What do I want my brand to stand for? And then you can also get into like, what is my investment thesis? Like, what do I believe is happening? What kind of deals am I going after? Why are they interesting? Why them rather than anything else I could be doing? There's an opportunity to create something new and then to tell a story about what you're doing that really appeals to me. I mean, I don't think this is unique to real estate. I mean, I think any business that you start, you have the opportunity to do this, to have a vision and then execute your vision. I think that's why entrepreneurs are, attracted to being entrepreneurs. There's a certain type of personality that just wants to get out there and create something new. But that's so for me, I mean, I find that I really love the marketing end of this business. I really love the content creation end of the business. It gives me the opportunity to kind of like really sit down and hone my thoughts about the market and then get those thoughts out there and see how people react to them. So I love that aspect of this business.
I'd like to jump ahead because we talked about the first apartment building that you bought. I know you bought more, but where are you now in the market? What is your take on where we are now in the market? And right now it's second quarter of 2019.
As we talked about when I interviewed you on my podcast, I'm quite a conservative investor. I've really been pretty much on the sidelines for a couple of years now as I saw pricing really getting aggressive on deals and found myself being constantly outbid, not even by a little bit, but by a lot, or having off-market deals come my way where the expectations of the seller were just way more than I was prepared to go, or way farther than I was prepared to go. So I really took a step back a couple of years ago and just it went into kind of more of a wait and see attitude. That evolved over time into, wow, not only is it not a great time to be buying right now, but it's a fantastic time to be selling. And I kind of took a look at the market. I looked at the properties that we owned, and realized on the one hand, for the properties that were underperforming, this was a really good time to exit at such a high valuation that we could turn kind of a dud into a good return for our investors. And for the properties that were performing well, the valuations that are out there right now for properties, I just felt like I don't know when this opportunity to sell at this kind of price would come again. And I really owed it to my investors to take advantage of that. So I wound up coming to the decision to exit everything, and recently closed on the sale of the entire portfolio. I mean, just to give you an idea of where things are in the market, these are deals that we bought all in 2014 and 2015 for a total of about $17.5 million. We put a little bit of capital into a couple of them, but we really went in with a buy and hold mentality at the time. We weren't doing heavy value add. I wasn't ready to take on that risk yet. I wanted to learn the business more before I started spending large amounts of capital to reposition properties. And really, without having done very much at all to these properties, just in the space of, depending on the property, 4 to 5 years of holding, we went from $17.5 million to $25.5 million, really without doing anything. And that, to me, says a couple things. One, it says that things are getting, for a while, have been really frothy because, why would somebody pay that much of a premium for the same asset, essentially, just a couple of years later, right? People are now, it used to be that if to part with $1, they required 10 cents in return. Now they require only 5 cents in return, but it's the same dollar. And that doesn't really make a lot of sense to me because not that much has changed in the economy to suggest that, that $1 is now worth half of what it used to be to get a return. So I feel that we're more looking at a situation where we're in a kind of bubbly situation for assets. This time around, it's not the average American running around and paying too much for houses, but it's people who believe that they're more sophisticated, so therefore they can't make mistakes, who are overpaying for commercial properties because there's cheap money sloshing around everywhere. So I don't think that this is going to have a happy ending, to be honest. And I feel pretty good to have exited, to be honest with you. The other thing that I was thinking about, with these properties is it's been a long time since we've had a recession. A recession is, in the next few years, more likely to happen than not. And the kinds of properties that we owned, which were, C properties, those are really the kinds of properties that get hardest hit in a recession. And I know for the last few years, there have been a lot of people running around saying, multifamily does well in recessions. Multifamily does well in recessions. It's just not true if you look at the actual data. What people are, what's happened is, if you look at the last recession, especially for C-class property, that renter by necessity renter is typically blue collar, and those are the kinds of jobs that get cut first whenever a recession happens. When you have a recession, your vacancy goes up in your C-class properties. You can ask any property manager; they'll tell you that. But what happened after the last recession was, after the recession, vacancy spiked a lot during the recession because so many people lost jobs. After the recession came the foreclosure crisis, and that led to a lot of people who otherwise would be buying homes turning to rentals instead. So rentals did really well after the recession, but during the recession, they didn't do so well. However, they did better than other kinds of commercial property, which did even worse, right? So I remember reading recently that multifamily was the most resilient property class in the last recession. And by most resilient, that meant that it only lost about 32% of value, right? That was the best performer. It was down 32%, as opposed to other property classes that were down even more. So what happened is you take those two facts, this like more resilient than the rest, plus what happened after the recession, and that gradually over time changed into a narrative of multifamily does well in recessions, which just isn't true. So looking at that situation, I thought, okay, I know what happens to the C-class renter when a recession comes, and I don't really want to be around for that to happen. So rather exit now when I can. So, we did that. We exited. We made really nice returns for our investors. Everyone is very happy. And we're just waiting to do it again now. But I think going forward, we'll probably shift our attention a little bit. I think we'll be looking more at the B-class deals. I think there are going to be a lot of opportunity coming up in the next cycle for the early 2000s vintage property, which is now edging up to 20 years old, to be, there's still, the systems are still good. They're still in relatively good shape. You don't have a lot of problems with like that older property, but you still need to upgrade units and just bring them up to a more modern standard. I think there's going to be a lot of opportunity in that space coming up. So that's where I'll shift my attention next. But for the moment, still in that kind of stand pat period, just, bringing on more investors who have a patient mentality, offering them the opportunity to be ready for the next go round whenever it happens, and sort of biding my time in the meantime.
Let's talk about fiduciary responsibility, because it's a term you brought up, and I think it's an important term, and you understand it very well as an attorney. There are people listening to this who may not be familiar with that term. Can you first describe it, then I'll follow up with a question.
Yeah, absolutely. So a fiduciary is any person who is in a position where they legally and morally must put their clients' interests ahead of their own, right? So, for instance, anytime you say you give money to a money manager, right, who's holding your money, right, that person now owes you a fiduciary responsibility. And what that means is they can't do something with your money at your expense, right? And they also can't say, for instance, like, let's say you were going to put a big trade on with stocks, and they're like, oh, wow, I see Jonathan is about to buy $1 million of Apple, right? And it's going to move $1 million of Apple probably wouldn't move the price. So just for the sake of the argument, right? Let's say I was going to buy a big enough block of shares that it was going to move the price of the shares when that order went through. They have a fiduciary duty not to front run you by making a trade, like buying the stock ahead of your order, so they can ride it up when the price moves, right? That's an example.
How do you apply it, and how do you think other investors who are working with their own investors' capital, private money, how should we apply that as well?
Yeah. So, well, for one thing, say you have a responsibility not to load up your deals with fees, right? You see a lot of people out there, not just in the real estate world, but in the investment world in general, where they're really loading up their deals with one fee after another. And even though it's legal for them to do that, and if they disclose it, it's legal, it's really not in the client's best interest, right? So fiduciary duty means that you're putting your client's best interest ahead of your own. If your deal is not making money, right, you promised your investors a certain return, you're not hitting the return, or you're not paying, let's say you're not paying them any money on a deal. Are you still taking a fee to manage the deal? Or, if it's the difference between you getting paid and your investor getting paid, are you paying yourself instead of paying your investor? If you're really exercising your fiduciary duty, then you would pay your investor before you pay yourself. Another example might be, and this is sort of like a classic breach of fiduciary duty, but let's just say you wanted to sell a property, right? And just to throw a number out there, you knew you could sell this property for $5 million, right? But some buyer comes to you and says, hey, Jonathan, how about, let's do this. How about I pay you $4.9 million for the asset, but I'm going to give you a side payment of $50,000 that you can just put in your pocket, right? I'll save 50, you'll get 50. Your investors are still going to make plenty of money, and they won't even know that you just gave me a $100,000 haircut for a side payment. Like, that's a classic breach of fiduciary duty. Now, I think those kinds of things are pretty rare, but it's just a good example of what it means to put your investors' interest ahead of your own. If you were exercising your fiduciary duty, you would never take that side payment, to benefit somebody else, because your duty is to maximize the price that you're going to get for the asset for your investors. The real key to fiduciary duty is just remembering that if there's ever a conflict between your personal interest and your investor's interest, you have to choose your investor's interest, right? But you may be in a situation where you're just faced with two choices and there's no conflict, right? There's just, is it better to get the cash flow or is it better to sell the deal? Like there's no conflict there necessarily. There are two options that both benefit your investors, they just benefit them in different ways. And then it's just a business judgment as to which one you do. But the real issue is for fiduciary duty is, who are you putting first? Are you putting your own interest first, or are you putting your investors' interest first? And I think I see people out there doing things that they're legal, but they're not necessarily putting their investors' interests first. They're doing them because they can, right? So for instance, one thing I see is deal sponsors taking a separate fee for signing on the debt, right? So it's always been to my mind, and I think a lot of people will agree with this, that the sponsor, that's part of what you're getting paid for, is like signing on the guarantees on the loan, right? Mm-hmm. That's why you're getting a promote in the first place. Otherwise, why are you getting some compensation for finding the deal and putting it together, but part of it is the risk you're taking on the loan, or even the non-recourse carve-outs, right? That's part of what you're getting paid for. So then to take a separate fee for doing what's already your duty to do seems to me to be, I don't know, it doesn't rise to the level of a real breach of fiduciary duty, and you disclose it in your documents, it's legal as long as you disclose it, but it's not really like putting your investors ahead of your own interests, right? And I think, you see it happening now because investors are so desperate to get into deals that they're willing to pay, they'll put up with any kind of fees because they've got stars in their eyes. And frankly, I think that even though it's legal because it's disclosed, a lot of investors look at these packages and don't realize what's going on. They see a fee being paid, but they don't realize that that name of the guy who's getting the fee is also inside the sponsor group that's getting paid to be the sponsor, right? They don't realize that it's a double dip, either because they're not paying close enough attention, or they just don't notice it, right? Or they just don't know who these people are, and they just figure whatever. But I think a lot of sponsors are sort of taking advantage of the fact that investors are greedy right now, and they're not really sophisticated enough to understand the structures of these deals.
Yeah. Excellent example. Thank you. As we wrap it up here, Jonathan, why don't you tell us a little bit about what you have to offer and how people can get in touch with you?
Now, I do a podcast called Real Estate Launchpad. It's available on iTunes and everywhere else. We have a website, realestatelaunchpad.net. And if you go to realestatelaunchpad.net/booster, there's a whole suite of things that you can download there. There's a deal analyzer. There is an ebook about how to get brokers to pay attention to you even when you're new. There are a whole bunch of videos for you to watch. It's all free. So realestatelaunchpad.net/booster. If you'd like to get in touch with me about investing with me and joining my platform, you can go to twobridgesmanagement.com and fill out our investor form. That's Two Bridges spelled out, so TWO, Bridges, and then MGMT for management. So we have an investor form there. That's the sort of first piece of our intake process. And I'm always happy to hear from people. And the last thing you can do is join my Facebook group, where pretty much every day I'm in there giving free advice and answering people's questions about multifamily investing. Group is called Multifamily Investment Community, and just search for it on Facebook. It'll pop right up. Got about 5,500 members in there currently. So it's a great community.
Fantastic. And I'll make sure all that is in the show notes. Any parting thoughts for us? Anything you want to share with our listeners before we wrap it up?
So my take on multifamily investing now is that I'm long-term bullish and short-term bearish. So I do think we're ready for a correction, but at the same time, I feel like the multifamily industry has got a great future ahead of it. I think it's a terrific asset to buy and to own, as long as you're doing it at the right point in the market cycle, with really conservative underwriting. So it's something that I highly recommend people study about and learn more about if it's something that you're interested in doing. And I'm happy to help you do that if that's what you want.
Jonathan, I want to thank you for being on the show today. It's a pleasure talking with you and learning more about your history and your legal background and how you've applied that to investing in multifamily and syndication. And the stamina you showed early on, that 3 years of drought before you really found success. And I think that's inspiring. So thank you very much for being on the show.
Thank you for having me so much, Brian. I really appreciate the opportunity to speak to your audience.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.